When discussing a crypto project, it's impossible to avoid using technical terms because advanced coding terms are used to program these networks. If you're new to cryptocurrency, learning some of the most common crypto slang terminologies will help you get a better understanding of the ecosystem before you invest. Hi, this is Financial and Investment Wisdom. Make sure to subscribe to our channel and turn on the notification bell. This video dives into 20 popular cryptocurrency terms you should know to better understand project descriptions and crypto-related news. Number 1. Cryptography. The term cryptography is made up of two words, crypt, which means hidden, and graphy, which means writing. Cryptography is a method of protecting data and communications through the use of codes. It is the transformation of clear, easily read text into unintelligible text, and vice versa. This is the method for protecting your digital assets against theft or alteration, as well as for user authentication. The goal is to create an extra layer of protection for the data. Number 2. Currency. The medium of exchange for units is currency. Each unit has a monetary value and is used to pay for goods, services, and debts. In the crypto realm, Bitcoin is one of the most well-known and widely used currencies. Number 3. Blockchain. A blockchain is a digital ledger that allows for the secure recording of transactions. It is decentralized, which means it runs without a central authority. Instead, before a new record can be registered, it must be verified by a computer connected to a network known as a node. The name blockchain is derived from the network structure, in which each set of data is referred to as a block. From a chain, new blocks are added in a continuous sequence. A blockchain's records can't be changed or deleted. Instead, a new transaction must be created to fix any earlier transaction faults or errors. This makes it impossible for them to be tampered with. Number 4. Cryptocurrency. Cryptocurrency is a type of digital currency that is protected by encryption. It is not a physical currency because it is all done online without the involvement of a central bank, yet it may be used to purchase goods and services just like a physical coin. There are over 6,700 different cryptocurrencies according to CoinMarketCap.com. In 2009, Bitcoin was the first cryptocurrency to be introduced. Number 5. Block. Cryptocurrency transactions are recorded in blocks, which are files. It keeps track of each transfer and allows users to see what was paid for and by whom, reducing the chances of using the same cash twice. A block symbolizes the present by containing information about its past and future. When a block is completed in a blockchain, it becomes part of the past and makes room for a new block. The filled block contains all of the previous transactions, while the current one has all of the fresh ones. This cycle underpins the entire digital asset system. It also gives digital assets a higher level of privacy and protection. Number 6. Bitcoin. Bitcoin is the first virtual currency, created in 2008 by the mysterious Satoshi Nakamoto and first used in 2009. Bitcoin can be exchanged for other currencies, products, and services by anyone who has it. As a result, it has become one of the most widely used digital currencies. In 2017, there were between 2.9 and 5.8 million unique users of a cryptocurrency wallet, with Bitcoin being the most popular. Number 7. Altcoin. Except for Bitcoin, all other cryptocurrencies are referred to as altcoins. It's a mix of the words alternative and coin, or you might say it's a Bitcoin alternative. Because altcoins were created amid Bitcoin's massive popularity, most of them are based on Bitcoin's basic framework. There are about 9,000 cryptocurrencies available right now. According to CoinMarketCap, altcoins accounted for over 40% of the overall cryptocurrency market in March 2021. Litecoin, Ethereum, Ripple, Tether, Bitcoin Cash, and Bitcoin SV are some of the most well-known altcoins based on market cap. Number 8. Mining. Proof of work. Proof of work is the protocol that runs the Bitcoin network, POW. It's a consensus process for validating new transactions before they're added to the blockchain. Although anyone can theoretically become a miner, the procedure is energy intensive. To house high-speed servers, you'll need a lot of computational power, specialized equipment, and a lot of room. To validate a transaction, a miner or node made up of many powerful computers must solve a random mathematical challenge to generate the hash that will identify the new record. In the case of Bitcoin, each record will be hashed using the SHA-256 algorithm. A hash is a one-of-a-kind number that uniquely identifies a dataset. The distributed ledger is then updated to reflect the changes, allowing anybody to check the accuracy of new and updated entries. Miners are compensated in a proof-of-work ecosystem by earning a specified number of tokens for validating transactions on the blockchain. Number 9. Staking, proof of stake. Another technique that can be used to power a blockchain is proof of stake, POS. Only miners who stake their cryptocurrency in direct proportion to the number of tokens they stake can participate as validating nodes in a POS protocol. POS nodes, like proof-of-work nodes, must solve a mathematical challenge to validate all transactions. They are rewarded for doing so. On the other hand, miners will only be able to validate a certain percentage of blocks based on the number of holdings they've staked. POS is thought to be more energy efficient and safe than POW. Number 10. Smart contracts. A smart contract is an algorithm that is assigned to carry out a certain transaction based on a set of predefined parameters. The blockchain executes these contracts automatically once the parameters that govern them have been met. Once a contract has been included in the blockchain, it cannot be changed. Okay guys, wait for a second. I hope you are learning from this video. If so, please give us a like and subscribe to Financial and Investment Wisdom. Number 11. Decentralized applications, dApps. A decentralized application, a software built on an existing blockchain, is referred to as a dApp. The difference between a standard app and a dApp is that transactions are confirmed directly on the blockchain without an intermediary. Number 12. A wallet is a system that lets crypto tokens to be safely stored. Because crypto tokens are simply bits of code, the wallet serves as a repository for them. Without the owner's permission, third parties cannot access the codes in a wallet. There are two types of wallets: cold storage, not linked to the internet, and hot storage, accessed through the internet. Hardware wallets, which are physical devices like a hard drive, are also accessible. Only a smartphone or a personal computer can access mobile and desktop wallets, respectively. Number 13. Market capitalization. Market capitalization is the market value of a publicly traded company's outstanding shares. It's computed by multiplying the stock price by the number of outstanding shares. It is equal to the total number of coins multiplied by the current price in the case of cryptocurrency. Number 14. Distributed ledger. A distributed ledger is a database that is shared and collaboratively accessed by several people. To have public witnesses of all transactions, it is synchronized across many sites, institutions, or regions. Let us define a distributed system: several computers working independently toward the same goal as one large system. A ledger is a book that keeps track of all transactions, as well as any other data. Any changes to the ledger are immediately reflected and duplicated to all participants. The first type of distributed ledger technology is blockchain. Number 15. Fungible. The ability of a good asset to be interchanged with other individual goods or assets of the same type is referred to as fungibility. It signifies that one thing can be used in place of another without affecting the latter's value. When you swap fungible products or assets, you gain or lose nothing because they both have the same worth. Number 16. Peer-to-peer. Peer-to-peer refers to direct communication between two parties without the use of an intermediary. All blockchains are designed to function as peer-to-peer platforms. As a result, anything can be exchanged without involving a third party to validate the operation, as the blockchain itself carries that function. Number 17. Consensus. In a crypto dictionary, the term consensus refers to an agreement between the various agents that operate to keep the network's integrity. Most blockchains, for example, rely on a consensus method in which all parties agree that each new record added to the network has been properly validated. Number 18. Mint. Minting is the process of storing a file, such as a JPEG or GIF, in a blockchain. An NFT can be sold or traded once it has been minted. When you take part in a mint, you are the first person to purchase a piece from its creator. After that, you have the option of keeping it, selling it, or trading it. The creator specifies the royalties they will receive from future sales through the minting process. This serves as a commission if the piece is sold in the future, and it's a key selling point for artists who want to go digital. For example, if you sell an NFT on a secondary market, it will very certainly earn a percentage of the sale. Number 19. Fiat. I thought a fiat was a car, you might be thinking. In crypto land, it doesn't mean this. Government-issued money is known as fiat money. If you're in the United States, you're talking about the dollar. Cryptocurrency, on the other hand, is a type of digital currency. Governments or any other standard used with traditional currency do not back cryptocurrencies. Rather, each token represents the amount of money you have. Number 20. HODL. This is a term you may come across on social networking. Hold on for dear life is what HODL stands for. Some think it started as a misspelling of the term hold on a Bitcoin forum, but it's now common slang. The concept is simple. If you believe a project or currency will appreciate, simply HODL during volatile markets. So guys, the list of crypto trading terms may go on forever. Although being a relatively new and exciting asset class, cryptocurrency has been steadily becoming popular with global adoption continuing. According to the analysis titled Global Blockchain and Cryptocurrency Market 2021, blockchain technology is expected to become a major contributor to global GDP, increasing to $2 trillion by 2030. So what do you expect from cryptocurrency? Let us know in the comment section. We always appreciate your thoughts. Also, don't forget to subscribe to this channel and turn on the notification bell so you'll get updated on our future uploads. Once again, this is Financial and Investment Wisdom. Thanks for watching.